Somewhere in rural Illinois and rural New Jersey, private companies have quietly built a chain of microwave transmission towers stretching across hundreds of miles of open country. Not for phone calls, not for internet service, for one single purpose: to shave a handful of milliseconds off the time it takes a trade to travel between the Chicago futures markets and the New Jersey stock exchanges. Hundreds of millions of dollars spent on physical infrastructure to win a race measured in thousandths of a second. Now, if you've watched this channel before, you know what usually comes next. We tell you the physics claim in the title is a metaphor, a poetic framing, a useful way of thinking rather than a literal scientific fact. Not this time. This is the one video on this entire channel where we don't need that caveat. The speed of light is a genuine, hard, physical constraint on how fast a trade can possibly happen. Not a metaphor for anything, not a poetic comparison. A real, literal, immovable ceiling that the entire global financial system runs directly into, every single day, whether anyone in finance likes it or not. By the end of this video, you're going to understand why Wall Street has quietly become one of the strangest places on Earth, where Einstein's physics isn't just an interesting analogy. It's an actual line item in a trading firm's budget. Let's get into it. Here's the foundational idea underneath everything else in this video, and it's worth sitting with, because it's genuinely different from every other topic we've covered. Information, a trade order, a price update, a market signal, cannot travel from one place to another faster than the speed of light. That's not a limitation of current technology, waiting for some future engineering breakthrough to overcome it. It's a fixed feature of the physical universe itself, the same absolute constant that governs everything else light-speed related in physics. In high-frequency trading, this stops being an abstract fact you'd read in a physics textbook and becomes an active, operational constraint shaping billion-dollar business decisions. No matter how clever the trading algorithm, no matter how powerful the computer running it, every single trading firm on Earth is racing toward the exact same hard ceiling. And nobody, not the best-funded hedge fund, not the most sophisticated quant shop, gets to negotiate their way past it. Once your systems get fast enough, you stop competing on cleverness. You start competing directly against the geometry of the universe. Here's where this stops being a physics curiosity and starts being a genuinely strange business strategy. Wall Street firms are no longer competing purely on code, algorithms, or trading strategy. They're competing on location. If your server sits physically closer to an exchange's own servers, your trade signal simply has less physical distance to travel, which means you see price changes first, and you can react to them first, purely as a function of geography. In an industry that has spent decades brilliantly hiding wealth-generating decisions behind spreadsheets, models, and algorithms, one of the most valuable strategic advantages left on the table today is disturbingly simple, literally being closer to a building than your competitor is. Geography, in this specific corner of finance, has become a genuine source of trading profit, something economists call alpha, not because of insight or analysis, but because of physical proximity alone. Let's make the scale of what we're actually talking about concrete, because milliseconds doesn't naturally register as something that could possibly matter to a human brain. At the speed of light in a vacuum, light travels approximately 300 kilometers in a single millisecond, 1/1000th of a second. That's roughly the distance from New York City to well past Washington, D.C., covered in less time than it takes you to blink. And in high-frequency trading, differences measured in single milliseconds, sometimes far smaller, can determine which firm captures a fleeting arbitrage opportunity and which firm arrives a fraction of a second too late to profit from it at all. A gap of time so small that no human being could ever consciously perceive it happening is, in this specific industry, the entire difference between winning and losing a trade. Here's a detail that surprises almost everyone, including plenty of people who work in finance. You'd assume that fiber optic cable, the physical backbone connecting most of the world's financial infrastructure, moves data at the actual speed of light. It doesn't. Light traveling through the glass of an optical fiber moves at roughly 2/3 the speed of light in a vacuum, slowed down by the physical properties of the glass medium itself. That means even the fastest, most modern light speed infrastructure that most of Wall Street has historically relied on is meaningfully slower than the literal speed limit of the universe. This single physical fact, that light inside glass fiber travels measurably slower than light through open air, turns out to be the seed of one of the strangest infrastructure stories in modern finance, one we're going to get to in detail shortly. Here's a reframe that should genuinely change how you picture what a trading firm's technology budget is actually paying for. Modern computers can perform calculations at speeds that are, for almost any practical purpose, instantaneous relative to human perception. Computation is not the bottleneck anymore. The bottleneck is physical. However fast your algorithm decides what to do, that decision still has to travel as a signal through actual cables or actual air, covering actual physical distance, before it can reach an exchange and execute. You can have the smartest trading algorithm ever written, running on the fastest processor money can buy, and if your server sits 50 miles farther from the exchange than a competitor's server, you lose. Not because your strategy was worse, because physics doesn't care how smart your code is. Here's one of the strangest, most genuinely relativity-flavored ideas in this entire video, and it's not an exaggeration. Because light takes a measurable amount of time to travel between locations, market participants sitting in physically different places can, in a real sense, be observing two different versions of the current best price at the exact same instant, not because either version is wrong, but because information about a price change simply hasn't finished propagating to both locations yet. This isn't just an abstract curiosity from a physics paper. It's a genuine, practical complication for how modern markets function, echoing, in a real structural way, not the metaphorical way we usually frame these connections, the relativity of simultaneity problem Einstein described, where observers in different locations can legitimately disagree about which of two events happened first, because there's no such thing as a single, universal now, when the speed of information transfer isn't instantaneous. Here's a consequence of all this that regulators are still actively wrestling with today. If information about a trade reaches different locations at genuinely different times, purely because of physical distance and signal travel time, regulators can face a real, non-trivial challenge determining which transaction technically happened first, in cases where the timing gap is smaller than the delay caused by physical distance itself. This isn't a hypothetical edge case. It's a real complication that has shaped serious academic and regulatory research into how modern markets should be structured and monitored. When the physical universe itself introduces genuine ambiguity about sequence and timing, what actually happened first stops being purely a record-keeping question and starts becoming a question with actual physics embedded inside it. Here's a specific, concrete example of geography as alpha that connects directly back to something almost everyone watching has some passing familiarity with. For market-moving government announcements, interest rate decisions, economic data releases, policy statements, being physically closer to Washington, D.C., the source of that information, can mean receiving the underlying data measurably earlier than firms located farther away. We're talking about advantages measured in milliseconds, sometimes less. But in a market where those exact timescales routinely determine trading outcomes, physical proximity to the literal source of government information becomes a genuine, quantifiable edge, entirely independent of anyone's actual analytical skill. Here's the economic engine that makes all of this infrastructure spending make sense in the first place. High-frequency trading strategies frequently earn only a tiny amount of profit on any single individual transaction, fractions of a cent in many cases. The profitability comes entirely from scale, executing an enormous volume of these microscopic margin trades repeatedly throughout every single trading day. When your profit per trade is measured in fractions of a penny, but your trade volume is measured in the millions, speed isn't just a nice-to-have advantage. It's the entire foundation the business model is built on. Losing a millisecond doesn't just mean losing one trade. It means losing your structural edge across your entire trading volume simultaneously. Here's where this genuinely stops feeling like a finance story and starts feeling like a physics engineering problem with a trading desk attached to it. Some firms now choose where to physically locate their data centers and which specific markets to actively trade, based partly on physical distance calculations rather than purely on traditional financial analysis. The question, should we trade this asset, increasingly gets answered alongside the question, how many milliseconds of light speed delay separate us from the exchange where this asset is priced? Physics has quietly become an actual input into corporate strategy decisions, sitting right alongside traditional financial considerations, in a way that would have sounded like science fiction to traders a few decades ago. Now let's tell the story that opened this video in full, because it's one of the strangest, most genuinely underreported infrastructure stories in modern finance. Remember that detail from earlier, that light traveling through fiber optic cable moves noticeably slower than light traveling through open air. High-frequency trading firms took that physical fact extremely seriously and built an entire alternative transmission network around it. Instead of relying on fiber optic cable running underground between Chicago's futures markets and the stock exchanges clustered around New Jersey, several firms constructed private chains of microwave transmission towers, running in as close to a straight line as physically possible across hundreds of miles of open countryside, transmitting trading signals through open air instead of through glass fiber. Because microwave signals travel through air at speeds much closer to light's true vacuum speed than fiber optic signals do through glass, and because a straight-line air path is shorter than a cable route that has to follow existing rights-of-way. This microwave network shaves several crucial milliseconds off the transmission time compared to the fastest fiber routes available. This infrastructure reportedly cost hundreds of millions of dollars to build. The advantage it provides is measured in single-digit milliseconds, and multiple competing firms have built nearly parallel networks, essentially racing each other to build the most physically direct path between two cities, purely because a handful of milliseconds is worth that much money in this specific industry. Here's a detail that pushes this story from impressively fast into genuinely surreal territory. Research examining high-frequency trading systems has found that even 1 to 2 microseconds of timing inconsistency, what engineers call jitter, tiny, unpredictable variations in exact signal arrival time, can meaningfully confuse trading algorithms that are calibrated to expect extremely precise, consistent timing. A microsecond is 1/millionth of a second. It is, by any normal human standard, an absurdly, almost comically small unit of time, far smaller than anything a human nervous system could ever consciously register. And yet, in this specific corner of finance, a timing variation that small is large enough to meaningfully disrupt algorithmic decision-making. The scale this entire industry now operates on has genuinely outpaced ordinary human intuition for what fast even means. Here's a detail that brings this entire story down to a scale you can actually picture with your own eyes. Light can travel the length of Broadway, the famous street running through Manhattan, in roughly a microsecond. That means, at the extreme timescales high-frequency trading now operates on, even the specific layout of city blocks, the exact physical routing of cables through a building, and the precise floor of a data center a server sits on can become genuinely relevant variables in a trading firm's execution speed. This isn't an exaggeration for dramatic effect. It's a real engineering consideration that data center operators and trading firms actually account for, down to decisions as granular as which specific floor of a building to lease server space on, because even that small a difference in physical cable length can matter at these timescales. Here's the sentence that captures why this topic deserves an entire video of its own, rather than just being a footnote in a broader story about trading technology. High-frequency trading is genuinely one of the only places in ordinary, everyday economic life where Einstein's ideas about relativity and the finite speed of information aren't just theoretical curiosities. They actively shape real trade execution, real infrastructure investment decisions, and real regulatory policy. Most people go their entire lives without relativity meaningfully touching any decision they personally make. In this specific corner of the financial world, it's a line item in a budget, a factor in choosing a building, and a genuine open question in ongoing market structure research. Here's the pattern tying every single fact in this video together into one coherent story. For years, the race in high-frequency trading was primarily a software and computation problem. Build faster algorithms, build faster processors, shave microseconds off calculation time. But once computation gets fast enough that it's no longer the primary bottleneck, the remaining source of competitive edge stops being a software problem entirely and becomes a pure geography problem, where exactly your servers physically sit, how your signal physically travels, and how many miles of real, physical distance separate you from the exchange you're trying to reach. That's a genuinely strange endpoint for an industry that spent decades being described, reasonably, as being all about clever code and sophisticated mathematical models. At the extreme edge of speed, cleverness runs out of room to help you. What's left is pure, unglamorous physical geometry. Let's address the debate that's been quietly sitting underneath this entire story, because it's genuinely one of the most contested topics in modern market structure, and this channel doesn't shy away from acknowledging real disagreement. Critics of high-frequency trading argue that this entire multi-hundred-million-dollar infrastructure arms race amounts to a kind of legalized front-running, firms paying enormous sums purely to see market information microseconds before everyone else, and profiting from that tiny informational head start, without providing any genuine analytical insight or economic value in return. From this view, the speed race is closer to an expensive, sophisticated toll booth, extracting value from ordinary investors and institutions who simply can't afford to compete at these timescales. Defenders of high-frequency trading argue the opposite, that this speed competition provides genuine liquidity to markets, narrowing the gap between buying and selling prices for everyone, and that the competitive pressure to be fast is precisely what keeps markets efficient, keeping prices accurately reflecting available information as quickly as physically possible. We're not going to tell you which side is right. This is a genuinely contested empirical and ethical question, actively studied by serious economists and regulators, without a clean, universally agreed-upon answer. But now you understand the actual physical mechanism both sides are arguing about, which is more than most people debating this topic on either side usually have. So here's what I want you to actually walk away with today, and this one's a little different from our usual takeaway, precisely because this topic doesn't need any hedging. On Wall Street, speed stopped being purely about computers and became a question of how physically close you are to reality itself. The market has become so fast, operating at timescales so far beyond ordinary human perception, that the actual literal speed of light has become a genuine trading input. Not a poetic comparison, not a useful metaphor, but a real number that shows up directly in infrastructure budgets, corporate strategy decisions, and regulatory policy debates. At this level of the financial world, distance stopped being simply geography. Distance became money, measured out in milliseconds and microseconds, priced into $100 million towers built purely to shave a few thousandths of a second off a signal's travel time. If you've been with this channel for a while, you'll notice this video breaks our usual pattern in one specific, important way. Every other video on this channel has opened with an honest caveat. The physics connection we're describing is a genuinely useful metaphor, not a literal scientific fact. Compound interest doesn't literally violate physics. Markets aren't literally quantum systems. This video is the exception, and it's worth noting explicitly why. High-frequency trading is one of the rare places where the physics isn't a metaphor for anything. It's simply, directly, literally true. Light cannot travel faster than light travels, and an entire industry has been forced to build its business models directly around that immovable fact. That distinction matters because it shows this channel's entire underlying thesis working in both directions. Sometimes physics offers us a genuinely powerful lens for understanding finance metaphorically, and sometimes, as we've seen today, physics simply reaches directly into finance and starts writing the rules itself, with no metaphor required at all. The fastest traders on Wall Street aren't really buying speed. They're buying milliseconds, tiny, almost unimaginably small slivers of time, purchased through hundreds of millions of dollars in physical infrastructure, because at this scale, milliseconds are worth exactly that much money. Wall Street has reached a point where the speed of light itself is a business constraint, not a metaphor, not a poetic comparison, a genuine, immovable line item in a trading firm's budget, sitting right alongside payroll and rent. If this kind of thinking, where physics quietly explains the parts of finance nobody else is willing to explain, is why you're here, subscribe. New videos every week, breaking down the hidden math behind money. See you in the next one.